presentation will focus on ensuring continuity of your practice. It will last about 50 minutes, and if you have questions as we go along, please submit them online. We'll address them as often as we can. We'll also take questions verbally from those who raise their hands at the end of the presentation. Remember, though, that to ask verbal questions, you must have logged in using the audio PIN number provided when you logged into the webinar. As a reminder, this webinar is being recorded and will be posted to our website within a week. So if you have colleagues who couldn't attend today, please let them know they'll be able to view the presentation. Your presenter today is Mark Maurer. Mark is living proof that sometimes tradition is a good thing. He joined Low Load Insurance Services in 2003 and assumed his current role as president in 2008. He earned his CFP designation in 2006 to complement his bachelor's degree in business and finance and his MBA. Earlier in his career, he managed market operations for an energy trading company and financial operations for an international shipping company. Mark is a member of the National Association of Insurance and Financial Advisors and a popular speaker for financial organizations, including the Alliance of Cambridge Advisors, NAPFA, Garrett Planning Network, LIMRA, LOMA, and Society of Actuaries. He's also a contributing insurance resource to industry publications, including Businessweek, Bloomberg.com, Forbes, NAPFA Advisor, AMA Physician's Guide to Financial Planning, and Jane Bryant Quinn's book, Making the Most of Your Money Now. Please welcome to the mic, Mark Maurer.
Thank you, Dina. Hi, everybody. Thank you for joining us again in 2012, and hopefully it's a good start to your year. And so the point of my presentation, Business Insurance Preserving a Legacy, Protecting the Future, is hopefully to give you all something to think about for 2012. There are some possible opportunities with the linked gift and estate tax numbers right now. And so I'm going to talk about business insurance, but sort of with a twist on it. And anyone who wants to submit questions online through the GoToWebinar where you type them in, I will try to get to them as I go along. Otherwise, we're going to have questions at the very end. So our focus today, probably a little different than what you might have thought about when you saw business insurance, but when you scroll down a little bit, read about what I'm going to talk about. I want to talk about how insurance can help ensure your business will continue on after you, either the founding financial advisor or for younger planners who are looking at joining a firm and possibly buying out a firm, a way to think of cultivating the next generation of clients there. I'm going to preface this with saying I'm not telling you how to run your practice, but this is just an idea that's come about. We've seen it with other advisors, firms. We've even had a similar scenario here with Low Load Insurance Services. I joined on about 8 years ago, almost 9 years, and before I joined on, planners, Keith and Judith had noticed that some planners who they'd been working with for a while weren't calling quite as often. They called them and said, why it seems like the business is trailing off a little bit and clients are referring to us. And the point was, Keith and Judith they haven't retired, but at that point in time, look like they might be retiring soon. It was the continuity in the business that some advisors were wondering about. Well, as soon as I joined 8 years ago, I'm in it for the long haul, and all those advisors said, it's not just somebody younger in the practice, it's another Maurer. Whether that's good or bad, I'll leave that up to you. But there's continuity there, and so for the clients, there's continuity. I want to talk to you just a little bit about how to think about where are your next generations of clients going to come from and how to possibly think of that. In the scope of this, I want you to think about what are underperforming or inefficient legacy assets. I'm going to talk about succession planning for, not as we normally think, but what are assets that can provide a legacy to your clients' children. Having this conversation with your clients and their children. the idea of bringing everybody along may be another good way, so that when your clients, mom and dad, your clients die, that son and daughter and other son who now just inherited all of parents' assets know who you are. And I'm also going to talk about, we are an insurance, we are low-load insurance services. I'm going to talk about how to use permanent life insurance to create client succession. All of this, what does this do? It adds value to potential buyers and employees. If you can always have a continuous stream of new clients, or think of it this way, the money that you are managing or the assets never really leave, that's quite a potential income stream. I'm going to talk about capital transfer in the way that capital transfer is what sometimes we see us in the media, in the insurance industry. Capital transfer is really nothing more than the idea that of the $64.5 trillion of net worth that Americans have, baby boomers control over 50% of this. And at some point, baby boomers are going to transfer this capital on to the next generation. 1/3 of the wealth is controlled by retired or partially retired households. So we have people who are not necessarily concerned with income replacement or getting to retirement. They're at retirement. You're looking at, I'm not worried about, am I going to have enough to make it to retirement, and not necessarily am I worried about having enough to live on. We're looking at talking about people who are starting to think about not only their own mortality, but how do I want to pass my assets on at my death. As much as $25 trillion in assets will be passed on to the next generation over the next 20 years. Now, to the government, that may not be a big number. To me, that's a really big number. Trillions of dollars are going to pass on from who are currently your clients to their children. Are those children going to be your clients? And from a LIMRA study, 55 to 80-year-olds, 65% said that it is important to them, it is a primary goal of them to leave some proportion of assets to charity, inheritance, or other legacy goals. Now, so for 35% of people, they don't care what happens. This isn't for them. This is for your clients who are retired, are looking at some of these things and say, I want to pass money on to my kids. I want to pass money on to my charity. And so this is of interest to those clients, approximately 2/3 of your clients. 35% have assets that are dedicated for this purpose. It might be an IRA. It might be an annuity. And I have an argument which one of those is the most efficient to pass on at death. I can make an argument for either one both ways as being the most inefficient to pass on at death. So if they're saving their IRA or an annuity to pass on, I'm going to show you better ideas. And other people, 6% are actively saving part of their income for this purpose. Remember, it's a primary goal. It is important to them to pass something on at their death. 35% of that 55 to 80-year-olds, 35% of them are not taking withdrawals from assets to meet their monthly needs. They're living off their pensions, Social Security. Imagine that as time goes on, fewer and fewer clients are going to have pensions, but those baby boomers, many of them still do have pensions. So the assets, they aren't dipping into them. They aren't accessing them. It's just money that's sitting there. 31% are taking occasional withdrawals. So 1/3 are not taking any withdrawals, and 1/3 are taking occasional withdrawals, still covering most of their monthly needs. This one I think is particularly interesting. 80% of annuity owners die with their annuities intact. Most annuities are sold or purchased with the idea of, I'm going to accumulate some money in annuity, and then I'm going to turn it into an income stream. That's how it's usually sold, I would imagine, to 90, 95% of people. Only 20% of the people who ever buy an annuity actually start doing it and start actually using the annuity for income. 80% of them die with them intact. Remember, I just said what are the two most inefficient things to die with to pass money on? One of them being an annuity. So 80% of annuities are not doing what they're best at. So, again, my summary when I talk about capital transfer, wanting to pass money on. You have clients who are 55 to 80 and want to leave a legacy. Many of them aren't taking withdrawals from their assets right now. Well, why do you care? And you're thinking, Mark, these are great. I like your numbers. Okay, some of my clients said they want to leave some money to their kids, and okay, but why do I care? Well, part of this is to identify underperforming assets, and some of those just are things that aren't very exciting. They have a fixed annuity that's not earning a particularly good interest rate, and the goal of it is to pass money on at my death. I'm going to show you how inefficient that is, let alone that it's not, may not have a very good crediting interest rate. Are there assets that you can bring under your umbrella? Again, I hate to harp on annuities, but 3 or 4 years ago when your clients came to you and you said, I'm going to review all of your assets and here's this, that. Oh, and you have that $100,000 annuity, but I don't really review annuities, so we'll just leave that alone. Maybe here's an opportunity to bring $100,000 that maybe you hadn't looked at before, hadn't considered, and do something different with it. If a client has CDs that are just sitting there, oh, this is what I'm going to pass on to my kids. It's not earning a great interest rate. And again, is this under your umbrella? Are you able to manage everything as efficiently as possible when we have to cut some of these pieces out? Again, why do I care? This is the one that I found fascinating. A mere 2% of children keep the money they've inherited with their parents' financial advisor. Now, for a number of you, that may sound about right. For a number of you, you might say, great, don't really care what happens when my clients die. For a number of you, that's a really, really big worry because we're talking about client continuation, client succession. If this number was higher, you wouldn't really have to worry about it. 98% of money that is going to transfer to kids from parents who are your clients isn't going to stay with you. Similarly, only 45% of wives keep their assets with the same financial advisor after the husband dies. Why? If I was in front of all of you, you could probably raise your hands, and I'm pretty sure I would get the two answers I want. First, well, why did the kids leave? The advisor has no relationship with the client's family. The second one, which I didn't write down here, why do wives leave? Because the financial advisor never talked to the wife, only talked to the husband. I think one of the biggest mistakes an advisor can make is talking only to the husband, assuming it's the husband who's working. It might be the wife. The issue here is that somebody was directing the conversation to one person, and so in this scenario, 45% of the wives, or 55% of the wives, didn't feel like she was ever involved, didn't like the financial advisor. That's just a mistake.